I'm very delighted to welcome you to the Center for Global Finance today on an extremely interesting topic of stock market participation and speculation in the Chinese stock market. But also importantly, to welcome to us a guest speaker who is a friend of the Center for Global Finance, a distinguished researcher for many, many years, and with whom I've had the pleasure of, getting to know. He has visited us here at the Center for Global Finance. So here is Professor Eric Girardin from Aix-Marseille University in France. Let me have the pleasure to introduce him much more formally and formally. And Eric Girardin studied at Paris, Sorbonne, and also Cambridge universities, and is now at the School of Economics at Aix-Marseille University, where I've had the pleasure to visit him and to interact with some of his colleagues. He's been very active in economics, active researcher, and we actually started the interaction way back when I was at the University of Birmingham, in which he was also a very frequent visitor. But he has indeed a number of PhD fellows and more than a dozen PhD graduates working on the Chinese economy and the Chinese financial system. But also he has conducted research for the Asian Development Bank, Asia Development Bank Institute, which is a component of the bank, the Bank for International Settlement, the European Commission, the OECD Development Center, and many other organizations, and has also been a visitor not only to us at Center for Global Finance at SOAS University of London, but also at the Bank of Finland, Beijing University, HSBC Business School, the Chinese Academy of Social Sciences, Fudan University. I could go on and go on, given his long interaction with a number of institutions. But particular about his resume is the particular work is being directed at the top level of some of the institutions. For example, he was a member of the Advisory Council of the Asian Development Bank Institute and sits on the board of the China Economic Association. He has coordinated a number of research projects, including the EU Marie Curie research contract on China's electricity industry. He has published prolifically, both in journals and also some books, and has been instrumental in some of the leading books on China, including, for example, the monograph on banking sector reform and credit controls in China, and also the book co-edited with our other friend, Zhenya Liu, on demystifying China's stock market, the hidden logic behind the puzzles, by paragraph in 2019, only a couple of years ago. But I also like to take this pleasure to introduce Eric as somebody that has supported the initiatives, joint initiatives that I've been involved in. When I was at the African Development Bank, he led a large project in support of the bank on risk management, and used his team at Aix-Marseille to take us through programs of risk management. So we have a person here today who is a distinguished academic and researcher, who also has impact in terms of the development of the profession over a number of years, and also has been in advisory capacities to many international organizations, including the Asian Development Bank and the African Development Bank, just like exam again. Eric, it's a great pleasure to have you on board. And let me invite you to start sharing your research with us. So let's give a hand of applause and welcome to Eric.
Okay, Victor, thank you so much for this very kind and exhaustive introduction. It's been a real pleasure working with you over many years and having a lot of discussions. So today I'm presenting some joint research with Zhenya Liu, and actually I will also mention joint research with other researchers. I've been involved working on the Chinese stock market with Zhenya for now more than 2 decades. And as Victor mentioned, we published a book, which I will flash out at the end, on the subject. So this is our work in progress, and I will start with explaining the motivation behind this work. The question is, well, should we welcome more stock market participation by individuals, or could that lead to more speculation in stock markets? Of course, we all have in mind the recent experience over the last few years in the US and other OECD countries that many individual investors have rushed into the stock market via online trading, which has led many people to think that this was typical herding behavior. However, these markets, as we will see later, are quite different from the Chinese stock market because they are traditionally dominated by institutional rather than individual investors. In the Chinese case, as you can see here, the domination of individual investors initially was complete. Really, they were the only guys in town. Now, of course, some institutional investors have grown, and some of them are quite large. But in terms of numbers, you can see that no country can beat 200 million individual investors. Now, of course, the starting point of this project is the concomitant acceleration in individual stock market participation in China.
Eric,
yes.
Can you see, I'm using slides at the moment.
Yes.
I can't see any slides.
Oh,
Asina,
really?
can you see any slides?
Oh, so.
No, me neither.
Okay.
Okay, I'm sorry. I go back. Apologies for that. You should have.
Problem.
Okay. Thank you for letting me know.
No problem.
Apologies.
No worries.
Okay.
Yeah, excellent. Now? Yeah.
Okay. The reason is I'm using Zoom and not Teams. That's my.
Okay.
Inability. So
I think you can now do the presentation mode.
Okay. Yes.
Click on the presentation mode.
Sorry for all this.
Yeah. Okay. Excellent.
So
yeah.
Really, the big numbers in China are very impressive, and we will see that it's not simply the numbers themselves; it's also the growth in the numbers. We will see that in a minute. And what attracted us to this project is the fact that this very rapid growth in stock participation has corresponded with a number of stock market bubbles in China. So the big message here for countries which are emerging or developing is that these countries have to be very cautious in trying to involve more investors in a risky market. We will see that in the Chinese case, this involvement of individual investors, may not always have led them to make money, rather the opposite. The literature in this field on stock market participation is, of course, important literature, but its main concern is the low level of participation of households in stock markets. This is one of the puzzles which literature has been focusing on, both theoretically and empirically, And the empirical work has mostly relied on cross-sectional survey data. Well, here we rather focus on new investors. What is it that brings new investors to the market? Why is it that during some periods we have a big growth in stock market participation? So that's really the sort of difference between existing work and what we are mostly doing. And we are going to do that both from a theoretical and an empirical perspective. And we will look at basically 3 series of major drivers, and this will be another novelty here. Usually people look only at subsets of those variables. And empirically, we will show that in the Chinese case, there is a big difference between, say, a normal regime where you have hardly any growth in the number of brokerage accounts, and a speculative regime where this growth is very high. The thing is that we will actually, of course, have to take on board the periods when we have bubbles, and we will, to do that, we are going to also look at the way to date bubbles. So this means that before we are able to go into the drivers of stock market participation, we really need to, number one, set the stage for the stock market in China, because maybe not every one of you is familiar with that very specific setting. And of course, the focus in setting the stage will be in the speculative character of the organization of that market, which leads to stock market bubbles, which I have dated with some other co-authors with, of course, up-to-date econometric technology. And secondly, I will go into the theoretical and empirical models which have enabled us to try and match these high growth episodes in brokerage account numbers and the stock market bubbles which we detected. So the first part will thus focus on some major anomalies in the Chinese stock market, which most of them are linked to this speculative character directly or indirectly. There are other anomalies which we detail in the book, which are not relevant here, so I will not deal with them at all. The starting point when we talk about anomalies in finance is, of course, the efficient market hypothesis developed more than 50 years ago. And from that metric, the anomalies in the Chinese case are, well, first, incompleteness. The market is not only incomplete, but also disconnected. I will explain what we mean by this. It's a segmented market, and it has a speculative character, I would say by construction, which is, of course, sometimes a little bit surprising, but it was designed like this, and it's still working like this. So the starting point is this quote from Franklin Allen and co-authors, where he considers that the Chinese economy among international peers is the best performing, but its stock market is the worst performing. Well, just to set the stage, Chinese economy, as we all know, is number 2 in the world, even number 1 in terms of purchasing power parity, with, of course, a very impressive rate of growth, even though, well, I'm also conducting separate work on reconstructing the true rate of growth of the Chinese economy over the last 40 years. So we have to take official numbers with a pinch of salt, but still, these numbers are certainly very impressive. In contrast, the stock market in China, which is also the number 2 in the world, if you put together Shanghai, Shenzhen plus Hong Kong, which are all part of China, they have shown a very poor performance. And the way we can illustrate that is to look in real terms at the index of the stock market. If you had put 1 RMB in 1992 in the market, in real terms, in 2013, you would still have 1 RMB. And even if you include dividends, this is not going to make much difference. So in the long term, you cannot have the sort of seagull type of recommendation for the US stock market, which is buy and hold. If you had this strategy in the long term in China, this would be, well, not a very good idea. This is illustrated here on the left-hand side with the real GDP of China started at 1 in 1991. And you see that in official terms, it went up by a factor of 8 by 2012. And on the opposite side, opposite panel, on the right-hand side, you also see the black line, which has the same level of 1 in 2013 as in 1992. The only, say, badly performing stock market we see, which is in pink, is a Japanese one, which, of course, is not an example of very good performance. Well, there are 3 major deviations from the sort of typical templates that we use for stock markets. The first surprising thing is that in China, it's not because you are shareholder that you own part of the firm. There is really a big difference. Mostly private investors remain minority shareholders. This is the first surprise. Second surprise is that dividend distribution by Chinese listed firms was initially almost inexistent. Later on, it has sort of appeared, but you cannot really rely on dividend distribution as a regular source of income. The third surprise is that earnings have been distorted in many ways, not only because state-owned banks, which have a big majority in lending, they charge very high interest rates to borrowers, so they sort of siphon out a lot of the earnings. And also the data on earnings published by firms are not reliable at all. They are massaged, and they are especially, say, inflated before IPOs and completely reduced after IPOs, which means that the relationship between reported earnings and stock prices is quite poor. So it's very important to keep in mind all these specificities of the Chinese stock market, which of course imply that you have to be very modest when you come from, well, if you are familiar with Western or OECD stock markets, and you approach the Chinese stock market, you have to mostly forget a lot of what you learned. The second series of anomalies is this segmentation, which takes the form of a premium, which is also unusual. normally the law of one price should imply that if you have a Chinese mainland firm, which is listed both in Hong Kong and in Shanghai, the price of the stock should be the same because the earnings of the firm are the same. Well, there are many barriers against arbitrage in China. I mentioned a few of them here. On market access and capital controls, foreigners cannot access as much as they want, only some of them. Gradually, these have been lifted, but it's certainly not enough. Short selling was initially not there. It only appeared roughly 10 years ago, and there are price limits and so on. And on top of that, you have traditional market frictions, which we are all familiar with, transaction costs, exchange rate risks, and so on. So this really is a big problem. And the result is a puzzle. In most countries, when you have a firm which is double listed, the price on the foreign stock market is higher than the price on the domestic market. And you have the example of several countries here where this has been documented, both emerging and very advanced countries. China is exactly the opposite to that. The domestic price is always larger than the foreign price. And there have been a lot of explanations put forward for this Chinese puzzle. They are listed on the right-hand side. And actually, with a colleague from Hong Kong, Zhou Feng, and a former PhD student, Jian Hua, we looked at this thing in a recently published article, and we showed that actually the exchange rate regime makes a big difference. This premium tends to be reduced whenever China moves to manage floating as opposed to a dollar peg. Of course, other factors like asymmetric information, the information available to investors in China is not the same as information available to investors outside China. So this is certainly an issue. Here you have an illustration of this premium. This is a price earnings ratio in the Shanghai Composite. This is a red line. And in the Hong Kong index for Chinese mainland firms, which is called H-shares index. You see that there are three major peaks in 07, 09, and 15. And there is only one exception to this rule, which is during the onset of the global financial crisis in late summer, early autumn 2008, where this premium was exceptionally reduced. So now we are moving to speculation and bubbles, but of course, when you see such premia, you already infer that during these periods, 07, 09, and 15, there must have been some factors which would have led this premium to rise. So, of course, when we look at bubbles and speculation, we have a well-known theory, especially developed by Schenkman and Xiong in a number of papers. And they basically say, well, if you expect a market to be speculative, it has to have a number of features. And, well, it so happens that the Chinese stock market perfectly matches all those features. We already mentioned this domination of individual investors. Here we go a bit farther by saying unsophisticated. And what do we mean by this? Well, in 2015, there were tens of millions of new individual investors who started participating in the Chinese stock market. And surveys show that for many of those, the level of education was roughly equivalent to leaving school at an age of 12 years. So I don't think they had any exposure to finance at all. The reduced float was definitely a major feature of the Chinese stock market up to 2006. At that time, they had a major reform called the split share reform, because before that, many shares were held by state or quasi-state institutions, so never traded. So there was a distribution of shares to non-state shareholders, which made the float closer to capitalization. Short sales constraints, underpriced IPOs. It's a tradition in China for many firms to set the price at IPO at a very low level, which means that on the first day of trading, the investors are going to make an immediate capital gain. This dominance of individual investors in the Chinese stock market, which of course has been diminishing over time, how can we explain it? Well, difficulty is that the portfolio choice of a household in China is very limited. Mostly, if you are a household, you are saving, you will park this in bank deposit accounts, but the interest rate on this is very low. So the alternative is not government bonds. Chinese households do not, as a rule, hold any of those for two reasons. In the 1980s, it was compulsory to hold these bonds. It was part of your pay package. And in the early 90s, the market was liberalized, but there were so many upheavals that the appetite for this type of financial product simply disappeared. And of course, we mentioned this issue of lack of financial expertise, which has been compounded by the influence of social media, on which we will come back in a minute. So now we use the standard framework to try and detect bubbles. We have the standard fundamental component, which here would be either earnings or dividends. Well, given what we said about the lack of dividend distribution in the Chinese case, it's a better idea to take earnings, even though, of course, we are fully aware of the limits of that data, but there is no true choice, no alternative variable. So, of course, the idea is, do we have an explosive bubble, which means the theta would be larger than 1? This is the way in which econometrics now works to detect bubbles. Of course, when we discuss with theoreticians, we have major problems, because for most theoreticians, it's enough for the price to deviate from the fundamental to conclude that you have a bubble. For an econometrician, this is a necessary but not sufficient condition. So I did some work with Roselyne Joyeux at Macquarie University, trying to detect these bubbles in the Chinese stock market. The intuition is to say we need to date the starting time of explosion in the price-earnings ratio and the ending time. So we are going to present this in the next slide, which of course presents the movement in the price-earnings ratio, and also the areas during which we have explosive behavior, and of course significant explosive behavior with the usual critical values. So this is a result of this test from 2003 to 2015. I did not put the thing longer because there was no bubble after that time. So you see that there are basically three series of bubbles which are very, very different, around 2007, 2009, and 2015. I'm going to come back to each of those now. The first bubble was, well, actually just before and during the early stages of the global financial crisis. You see that it's sort of, the bubble came and went and came back. And this was basically the result of this implementation of the split share reform, which I mentioned before. You have to realize that, and you can see it here in the price earnings ratio, that the price collapsed in the Chinese stock market. The index collapsed from the early 2000s until 2005. It's only when this reform was eventually implemented that expectations of earnings were quite optimistic, but they were disappointed, which led to this explosion, to this burst of the bubble in this fall 2007. The 2009 bubble is very surprising. Why? It's too short. Because the way that the Chinese government tries to avoid or alleviate the global financial crisis was through, I would say, a direct form of quantitative easing, as opposed to the indirect forms that has been used in OECD countries. Instead of providing liquidity to banks and hoping that they would lend, the Chinese government ordered state-owned banks to lend. And whenever you tell a Chinese bank to lend, it's going to overdo it. So the expansion of bank credit was like 30% in 1 year. And we are a little bit surprised here that the bubble would not be longer. We see that the price earnings ratio certainly rises, the blue line, but it's not explosive. So this is certainly a big surprise. Actually, I have an explanation in some other work that we did. We detected real estate bubbles, and just after that, the duration of the real estate bubble was certainly much longer than the one in the stock market. Finally, the third bubble was in late 2014 until June 2016. It stopped a little bit. In the initial phase, the government was sort of stimulating the market. It was telling shareholders, well, you should buy more shares, you are good citizens, so on. It was also relaxing rules on margin trading. And the central bank was providing more liquidity. Later on, the regulator started to calm the game, but it didn't work. It's only when the regulator became very serious, mid-June, when it increased the margin lending limits, that basically the government pricked the bubble. We have now reached our second part, which is going to look at the drivers and the dating of waves of new stock market participation. So what are the objectives of this work? Well, we want to explain large waves of these new individual participation. Actually, work in this area has been going on in different stages, I would say. Initially, work would only focus on quite standard fundamentalist versus chartist drivers. A little bit later, some work has emphasized the role of social interactions, in particular through online social media, but not only. Of course, it can be physical interactions, leading to herding in entry behavior. And much more recently, and completely unrelated to the other work, and also dealing a lot with China, actually, a new driver has been emphasized, which is funding liquidity requirements. Because if you want to open a brokerage account, you need to put money into this account. So basically what we are going to do is, for the first time, try to encompass the three series of drivers of new participation in the stock market. We will take advantage of the fact that China is rather unique in terms of the availability of data on brokerage accounts. Even for the US, you will have a lot of difficulty finding such data. You can find disaggregated data over short samples or specific for some companies and so on, but very difficult to find for roughly 15 years such rich data. So we will, of course, try to see whether these periods of high growth in brokerage accounts would match these three bubble periods that we have detected, and also whether any of those three candidate drivers would play a role or not play a role during such speculative episodes. So, of course, we will first start with the relationship with previous literature, present briefly our theoretical framework, mention also briefly the data, and then presenting the main results of the study in the empirics. But all of this in a rather concise way. So initially, as I mentioned, these works would focus on the decision of investors to enter the market, first due to stock returns and market fundamentals. However, in the most sophisticated heterogeneous agents model version of these approaches, there is something which is a little bit surprising and not adapted to the Chinese case, which is that it looks at existing account holders' motives for participating, and it doesn't really look at the margin at the newcomers, which we rather favor in this work. Now, the interpersonal interactions, so-called word of mouth, have been, of course, emphasized a lot, either via interactions with friends, with neighbors, who have themselves experience in making money in the stock market. And here, evidence in the case of China with a lot of survey data has been done, especially for regional data. The funding liquidity here, the existing literature has two interesting effects. The first one is a quite intuitive direct effect of credit booms. So if bank lending increases, then of course it means that investors who didn't have enough liquidity to invest in the stock market, now they can of course start doing that by leveraging and so on. Okay, but now an indirect effect has been emphasized, especially by Hansman and others, 2018, in which they basically say, well, some guys are smarter than others. So basically, they anticipate that credit supply is going to rise, and they are not themselves constrained by this availability of credit. So they basically start buying even before credit increases. So this they have called an indirect effect of this funding liquidity source. The empirical literature has been both low frequency with annual data on cross-section on the opening and also holding of brokerage accounts, which involves many different elements, which of course some of them are impossible to take into account when you are looking at time series, like education and things like this, or trust. One feature here is that most of this work only looks at linear effects, which, of course, given our concern, is certainly not appropriate. Some work does look in the time series framework with high frequency data at nonlinear effects and definitely find some dependence between brokerage account opening and stock returns in extreme cases. So that's certainly very valuable. But, well, some other work definitely also looks at those issues, but without having access to brokerage account data, only looking at price data. So they indirectly inferred some chartist and fundamentalist behavior. Well, I will not dwell too much into these work on social interactions. I will emphasize only that some of this work, in the Chinese case in particular, which I referenced here, they look at something which is very fashionable, which is a sentiment index, which most of the time includes stock market participation. But they only look at the one-way effect from sentiment to stock returns and not at all to the reverse effect. So, and again, this disregards these non-linearities. The funding liquidity literature is very interesting because it has looked at the Chinese case in a very intensive way around the 2010s, and especially the special period we saw in the first 6 months of 2015. And they find that margin lending played a very, very important role. And here it's margin lending not only via official channels, but also via shadow banking. So this is very interesting because they have a very rich data set, which of course implies that this leverage plays a major role, as we would expect in speculative periods. Hansman gives some interesting magnitudes of the size of such margin lending. You see, more than 3% of GDP or 4% of capitalization. So that's certainly, and they do validate the indirect effect as opposed to the direct effect of these lending waves. Now, the theory we are looking at follows a number of pioneer papers, especially a lot of them by Westerhoff, as we will see later. And these papers focus on the attractiveness of the stock market, which is the individual's intensity of opening brokerage accounts. What does this attractiveness depend upon? Initially, in the work of Westerhoff and others, only on chartist and fundamentalist variables. So we extend that, taking into account interpersonal interactions. Difficulty is, how can you proxy for that? Well, in line with existing work, also by Westerhoff with different co-authors, we proxy that by the persistence in the growth of brokerage accounts. The funding liquidity needs, well, here there are two sources. One is bank deposits for the investors who are not constrained by the availability of credit, or borrowing, and borrowing either from official channels or from shadow banking. So here, these are the sort of new features of our theoretical work, looking at newcomers rather than at existing accounts, and also modeling jointly, as I mentioned before, the three major candidate drivers. So here, equation one is the price of the, say, stock index as a function of stock market participation, small n. We have this attractiveness, capital A, which depends on a sort of chartist term, which is stock returns. Then we have the fundamentalist term, which involves the excess of the dividend price ratio over the safe interest rate. We have the persistence effect in the which we consider as proxying for social interactions, and then we have the funding liquidity proxy. And of course, this rho factor is assumed to be positive. So the solution of this model involves these three series of drivers. Why three? Well, social interactions, number one, then the standard chartist fundamentalist ones, which can, of course, play, as we will see, in opposite directions. And finally, the growth in funding liquidity. So the data we have put together, I'm not going to detail this construction, which was, well, quite time-consuming, because there is a lot of double accounting in this, or double counting, I'm sorry, in this recording, because investors would often open two accounts, one for Shanghai, one for Shenzhen, and so on and so forth. So, well, we eventually managed to disentangle all these things. The source is the CSDC from China, and the sample is from 2003 to 2019. We seasonally adjust the data, and we look at the rate of growth of this number of accounts. And you can see on the right-hand side that during some episodes, this rate of growth was absolutely stunning. The picture is at a monthly rate, but at an annual rate, you see that this can represent a growth of 70 to 80% during periods when when stock returns could also really be quite amazing. And you already see that 2007 and 2015 look like very serious candidates for these high growth episodes in the number of accounts. On the left-hand side, you have below this same number of account growth, you have the stock returns, you have the earnings price ratio gap over the safe interest rate, which in the Chinese case is a deposit interest rate. And on the right-hand side, in order to proxy for funding liquidity, we took the principal component, the first principal component of these three series, the growth in bank deposits, the growth in bank credit to non-financial agents, and the growth in shadow bank loans, which is also available in the Chinese case. So we use a Markov switching model because we certainly expect non-linearities to be present. And we expect that there will be two regimes and not three. Two means a regime with low growth in the account number and another regime with rapid growth in this number of accounts. And the reason we do not involve a third regime is, well, you can easily see it here. The episodes where you have a negative growth are really the exception. Why? Well, because normally in China, the accounts are never closed. So you open an account and you can keep it forever without any penalty at all. So this is our specification. All the parameters are regime switching. We are distinguishing mean regimes from volatility regimes. Why are we doing that? Well, of course, we checked that this was necessary, but also it enables us to identify the regimes in the growth of accounts as opposed to the regimes in volatility. If you confuse the two, you are not going to go very far. Otherwise, the variables are exactly the same as the ones I've now plotted. So I think I don't need to spend too much time on this slide. I will rather present the results. So we have two regimes they are identified by the intercept, which, of course, careful here, this is at the monthly rate, so you get the numbers at the annual rate on the left-hand side, which means that in the low growth regime, you have less than 1% per year, and it's even not significant. In the high growth regime, you have 8% per year on average, which is quite large. Now, the different drivers, we find that, of course, the chartist past returns, they hardly play any role in the low growth regime. The coefficient is very significant, but hardly different from very close to zero. We see that this 0.45 coefficient in the high growth regime is certainly very significant and sizable. We have the rather stabilizing effect of the fundamentalist variable. Remember, this is the earnings price ratio gap, not the price earnings ratio gap. And finally, we have the funding liquidity, which is equally powerful. This is, of course, our principal component. We see that we have an equal magnitude in persistence in the two regimes. We try to interpret this as the effect of social interactions, but of course, there could be many other explanations of this result. Now, these two regimes that we have distinguished, well, when did they take place? At the top, you have the dating of the bubbles, which I showed before. And now you have the dating of the high growth in brokerage accounts, which are the red parts in the lower panel. You have the precise dates of the two series of events on the left-hand side, and you see that, well, they really match very well. And it even seems that maybe the regime of high growth in the number of accounts would start a little bit earlier than the bubbles. Well, I would be very cautious in drawing such an inference from these results. Why? Because of something I did not mention. Our work on bubbles uses weekly data, so we have a very precise dating of bubbles. And of course, it's impossible to replicate that for the brokerage accounts because we only have monthly data. So I put the two together here, but of course, the timing cannot be completely matched. Finally, we are now reaching the conclusion of this presentation. Basically, well, I hope that if you were not already convinced, I've convinced you that the Chinese stock market is highly speculative, dominated by this large number of individual investors, some of them not very informed in terms of financial knowledge. There was no prior evidence on the role of the different candidate drivers of stock market participation, and even less on their possible regime dependence. So we used this monthly database, which is quite unique for China in terms of its time span. And we found that actually the feedback trading, the fundamentalist variable, the funding liquidity, they only matter during these bubble periods, while possibly social interactions always matter. So here we definitely caution maybe regulators about this type of market design. The fact that more individual investors participate in the stock market may not always be a good thing. We saw that in the US stock market some years ago. Now, the contributions of this work, well, I hope I've been clear enough on this already. We try to have this encompassing theoretical model, which is estimated empirically. We use these regime switching methods. And finally, again, emphasizing this focus on the growth in the participation rather than in the level of participation seems to be quite promising because the previous literature on the level has possibly put too much emphasis on this characteristic. Thank you.
Thank you very much. Let's give a hand of applause to Eric. You've covered quite a huge amount of ground and presented the work so clearly. That's and very interesting. Part one rolling, I say, into part two. Covered a number of areas that is interesting to know. Brought in some of the key aspects, especially I was excited when he brought in sentiment analysis in the work, but also the peering into the role of brokerages and all is very insightful. The theory is absolutely interesting. You covered provided the theoretical motivation, the computation, the access to the data, kind of exceptional. And given the combination of the two parts of the work, it was not clear to me whether there was, say, for example, somewhere buried in the details, and maybe which could be squeezed in the space of 1 hour, whether transaction costs play an important role here, because I think it's coming back in fashion, where stock market regulators use transaction costs as a way of cooling down the market when it is overheating, and also the removal of those costs to be able to expedite much more trading. But it may well be the case that the transaction costs are uniform across the all the brokers and investors, in which case it might not even be an explanatory variable. You know the data more than me. I also started thinking about the usual aspect in some of these markets is that sometimes the devil is buried in the details. In the sense that maybe the nature of the firms, participating firms or brokerage firms, that granular detail maybe starts to uncover differences much more expected. We know that sometimes some of these firms are state-owned firms, which are funded differently. And these state-owned firms also are driving the export market for China. Is their participation different or not? And maybe kind of the insights. Given that one of your publications is a book, I'm sure that that book maybe covered some of those aspects. So we're going to have a kind of interaction where we get some views from the participants, and also give Eric a chance to benefit from the views and the comments, and share back his thoughts. And so we are going into the cut and thrust of the discussion. Please put up your hand or post in the chat. And if I look in the chat, not yet in the chat, in terms of the hands going up, yes, I see the hand of a Hongbo, a professor of financial economics, who actually also actively researches on the China and the Chinese stock market. So, Hong, you have the floor.
Hi, thank you, Eric. Good to see you. And but yes, I have been working on China, but I'm not an expert like Eric has been doing, you know, in terms of the microstructure of the stock market. So I enjoyed your presentation, Eric. So actually, I would like to start with one of your contributions that you mentioned, that you said that in this research, you focused on the number of newly created brokerage accounts. My question and my concern is on this, because, and you said that in the literature, people have been doing quite a lot in terms of the level, but I think first of all, how much the volume of trading probably is also very important. If you want to explain the speculation or volatility or bubbles, etc. But my point is, I think, yes, I agree with you. Maybe the newly created number is important, but I would be more interested in knowing who those newly who those new investors are, and i.e. the structure of those new accounts. For example, if we see the proportion of Chinese institutional investors has been growing in terms of the individual investors among those newly created brokerage accounts, and that should be a good thing. And that should keep the stock market relatively stable as compared to, you know, the big population of the individuals. So that's my concern, because if you only talk about the number of newly created accounts, how do we know, and what are the policy implications that we can derive here? And in addition to that, if I look at your figures or diagrams, indeed, you have three, let's say, bubble period or something, and they are, to me, they are mainly driven by liquidity. So 27, 28, the financial crisis, because China was doing relatively well, more importantly, Chinese government, put forward a very big stimulus package, and you know that they were given a lot of liquidities, even to state-owned enterprises. So in one of the paper, we investigated the investment behavior. During this period, we found that actually Chinese state-owned enterprises, they actually invested quite a lot of their liquidity in stock market. So that is one piece of evidence that I want to know who they are. Are they state-owned enterprises? Are they state-connected institutional investors? Or are they all individual account holders? So that's basically, and in addition to that, for the bubble during 2015 and 16, you mentioned the margin, lending, margin trading, and that was indeed the very important event, I think, during that period. In addition to that, I want to add informal lending activities. Because after 2015, P2P lending, for example, was very actually popular. So as an individual, I can even go to a P2P platform to borrow something and then I invest them into the stock market. So that's my comments. But thank you very much, Eric.
Thank you, Hong. Very important observations, comments, questions. Maybe I can ask Eric to respond if he wishes to.
Okay, of course. Thank you so much, Victor, and thank you so much, Hong, for these very stimulative questions. Maybe I'll start with Victor on sentiment. Of course, sentiment is a very important indicator, but as far as we are concerned, we would like to see what is inside sentiment, because this number of accounts in some indices is one of the component variables inside sentiment. So my point would be to say, interesting, if you find an effect of sentiment on something, maybe you should look into the black box to see which component actually is at work. And vice versa, when you see what is driving sentiment, you should also see what is responding inside the sentiment index. Your second point about transaction costs, of course, they are important, but differently from other markets that we all know about, in the Chinese case, this is a relatively minor issue, given all the major issues we mentioned before. So really, I would not think that this would make such a big difference, because the frictions and so on, anomalies are so huge that the transaction costs are only tiny compared to all this. Now, of course, I understand the worry of Hongbo about these newly created accounts, and she would like to see a disaggregation between institutional and individual investors. Of course, that would be very nice, but if you want to conduct time series data over a 15-year period with monthly frequency, simply the data is not there. So what you mentioned is simply not possible. However, of course, when you see a rise by tens of millions in the number of accounts, it cannot be institutional investors. This is simply not possible. So the only convincing source of a huge rise in the number of accounts can only be individual investors. In terms of liquidity, yes, of course, this is very important. And this is why we, for the first time, introduce into these type of models the funding liquidity requirement. And definitely informal lending is important. This is why we include shadow bank loans, and all of them. So the ones you are mentioning are only part of it, and the data we have for China covers all sources of shadow banking. The last thing you mentioned is the liquidity provision by the Chinese authorities and the state-owned banks, especially in the first half of 2009. But as we documented, this did not lead to a big stock market bubble. So here there is a big surprise, because you said the state-owned firms could use their borrowings to speculate in the stock market. Well, at that time, they didn't seem to have done it in a way which would have led to an explosion in the stock index. It doesn't mean they did not do it, but they did it in a smooth way. It didn't lead to a big explosion. This is, I would rather think that, as I mentioned before, this big chunk of money was directed towards the real estate market. Thank you.
Thank you. Thank you.
Thank you, Eric, and thank you, Hong, once again. I can see in the chat a very interesting comment from Jaideep. So Jaideep, if you are still with us, maybe you can put forward your contribution as a comment. Yeah,
sure.
One question.
Thanks, Victor. Hi, thank you very much for a very interesting presentation. I was just curious because I was thinking about the other kinds of behaviors you would expect in these kinds of markets. Of course, with such extreme differences in terms of the scale of the bubbles. I mean, from the supply side, like the behavior of the actual corporations and the people who are raising these funds. I mean, do we see increases in IPOs and SEOs in response to these waves of like these bubbles? Do we see sort of fraud or bankruptcy changes in waves at the same time, like post-bubble or pre-bubble? Is there anything that sort of shows that the sort of the financial side of the sectors, like the corporate sector, is responding to these market gyrations?
Well, so thank you so much for this very stimulative question. This supply side thing is of course important, but we have not looked at it. It's certainly something we could look at in the future, because we definitely have the IPO data. So, and this is high frequency too. So definitely you are right. This is an interesting candidate to see which is a causality. Is it before, after? But remember what I said, and maybe this is what led you to this suggestion, that definitely this underpricing of IPOs is really used to be a major feature. I'm not sure it's as much as important now as it used to be, but this was certainly a traditional feature. So would firms take advantage of bubbles? Well, on the basis of this argument, you see that this underpricing itself is a source of bubble. Of course, this is a little bit controversial because it's not a source of persistent bubbles. It's a source of maybe immediate bubbles or short-lived. So that's your point. If we had a sequence of IPOs, then this could generate a bubble because of the underpricing. But that's not exactly your suggestion. Your suggestion was rather whether IPOs would respond to bubbles.
Mm-hmm.
And also whether the underpricing itself, how we measure it in a bubble, is a bit tricky. So
yes, absolutely. But your initial point about the number of IPOs This is easy to record and to relate to the bubbles. Yes, so thanks very much for this very insightful suggestion.
Thank you.
And the bankruptcies, the frauds, well, I suppose here we would need some media data or things like this, which would certainly require. And the difficulty is possibly that these bankruptcies and so on, the time of reporting may not be precisely real time. So maybe we would have to be a little bit careful.
Thank you both. Thanks, Jaideep, and thanks, Eric, for the responses and the discussion. In fact, if one was to continue the discussion on those along those lines, one would be thinking about activities like mergers and acquisition, M&A, and just to check whether you observe any M&A activity in the data, during those periods.
Well, thank you for this suggestion. Again, this is something we should be doing, but we have not done that. We have, well, you are familiar to that. Doing research, we have to be extremely focused.
Exactly.
So these are new developments, but well, the thing is that when we studied bubbles, actually in this work with Roselyne Joyeux, we are not only looking at bubbles in the Chinese market, we are also looking at bubbles in the greater China area. So also Hong Kong, Taipei, and so on. So this is the idea of what people used to call contagion, but it's not anymore called contagion, it's called migration. In the technical literature, it's called migration of bubbles. So we have certainly looked at that. So we have rather adopted an international perspective rather than looking at these very important issues that you and Jaideep mentioned on the activities inside the Shanghai stock market. But we certainly should do that in the future, based on your very nice suggestions.
Thanks so much. And let me now go back to the seminar participant to see whether there are any hands going up for questions, observations, comments. This is work that could be extended in many directions. And I think Eric's presentation does create a lot of interest in terms of, what one would need to expand in this particular work. So you are actually blazing the trail of future work on this. On the Chinese market, whether you are looking at the market microstructure issues, whether you want to drill down into a company behavior in the market, all of this is particularly motivating, including, of course, to even look at into recent issues, recent problems like, the COVID hits, there are possible extensions, of this work. And in a way, what Eric provides us is a firm foundation that we can base on to go forward. And the data is exceptional, by the way. Your data access, as you mentioned, in brokerage is very even difficult to get even in industrial markets. So that must have taken a lot of patience, patience to get into the granular data and to be able to then compare the analysis. Now, let me invite Bo. He's a professor at Linköping University in Sweden and a very active participant in the African Economic Research Consortium Group C and the financial economics part. So, Bo, thank you for joining us. Please go ahead and continue. Yeah.
Thank you. I was interested. I read about I read about this shadow banking in China, but what type of data do you have for that, and how good is it? Because I just imagine that it would be difficult to get decent data on it. My other question is that I don't really know which companies are registered on the H market, but when I looked at the A and B shares in China before Chinese investors were allowed to buy B shares, then we found that there was a huge difference between the older firms and the more younger firms. So old firms dominated by the state and the younger high-tech firms. We find that the valuation was completely different than for the old firms when compared A and B shares. But for the newer firms then at Shenzhen, we find that there was a more stable risk premium between them. But for the old firms then, it was a huge difference. They were basically a non-stationary risk premium. So are they very homogeneous, the firms that are also sold on, say, the H market?
Thank you.
Okay, thank you so much for these two series of questions. On the first one, the shadow banking issue, well, as Victor kindly mentioned, I already looked at these things not far from 30 years ago. Shadow banking is nothing new in China. It already existed in the mid-1990s. It was called trust institutions and so on. And the quite interesting idea is that in some way, state-owned banks are very often directly or indirectly involved. And it's not surprising because you know very well that they are the main receiver of bank deposits. So basically, they have excess liquidity. They are not allowed to lend more than, at some period, 75% of the deposits that they receive. So they have this big problem of excess liquidity, and they have been, over the last 30 years, trying to find ways to, well, you know, get higher return for that liquidity. People, of course, when they think of shadow banking, they would think that this is outside the official system and so on. I'm not so sure in the Chinese case. You know, you have to see what is the source of liquidity, and they are the source of liquidity. So this is not surprising that data would be available in the Chinese case. And as Victor nicely mentioned, the nice thing of a centralized system is that it records everything. So we also found that when we looked at the real estate issues, we were able to have an hedonic real estate price. Why? Because you have to report all the characteristics of the housing unit you buy. This has to be reported. Do you know many countries like this? Well, I don't. So, you know, in some way, there are good sides of these type of things. Now, your second series of remarks about the homogeneity or heterogeneity of the firms involved in the premium. Well, certainly there is heterogeneity. You mentioned the B share market, which used to be reserved to foreign investors at a time when they could not access the main A share index in Shanghai, like 15, 20 years ago. But this has been discontinued. Why? Because more and more the Chinese government has allowed foreigners to access the main A share market in Shanghai or Shenzhen over the last 20 years. It used to use very strange acronyms like QFII, Qualified Foreign Institutional Investors, which means that if you are a big foreign institutional investor, you would be allowed to invest in the Chinese stock market. And more recently, the Stock Connect, which has enabled two-way investment between Hong Kong and Shanghai or Hong Kong and Shenzhen. These are important things, which means that gradually this external financial opening has been going on. Now, it is true that we did not look at the nature of the firms involved in these premia. Yes, we did not. We did use, in the paper I mentioned with Zhou Feng at Hong Kong, Metropolitan University now, we did look at panel data, but we did not include the characteristics of the firms. This is certainly a very interesting suggestion. However, we already looked at so many issues that maybe the paper would have really been inflated. So you are very nice in suggesting a new paper, but I don't think the referees would have accepted us to go into yet another layer. But otherwise, yes, thank you so much for the nice suggestion.
Thank you once again, Bo, and thanks, Eric, for sharing those views. In fact, I think one of the most benefits of such a seminar is to provoke us to think about where this research is going forward. And always, I think there is a usual cycle of invitations, especially SRC invitations on work on the Chinese market. So I guess the current thinking would be, in what many ways do you think that we can extend this work? Maybe this is a tall order question, but in terms of by the end of completing these two parts of the issues you covered, there is already a tall order of issues that you wish you could cover, but of course they fall outside the domains of this work. Now, this audience has a number of people, including I can see a number of young researchers, PhD fellows, postdocs, who would be thinking of new ideas to explore. It includes participants from international organizations who would be looking for policy issues, and I think you did actually cover quite a number of the policy implications, especially when you mentioned regulation. But let me go back to this issue of where do you advise us to go forward? Is there something very promising you wish you could explore now that you would like to signal up, which would then be a natural extension of the work that you have very ably accomplished?
Well, thank you, Victor. For the extensions, I would say the people in the audience who have asked questions today have actually answered your question.
Including myself here.
Given us a very rich agenda on which to work. So I think this is enough to write maybe 2 or 3 papers. So I'm not sure I want to add to the list of this. Of course, maybe there is something which actually would attract a lot of interest, and rightly so. It is the role of social interactions. It's very difficult at the macroeconomic level to take that into account. So I think that among the different factors, this could be the most promising, because of course we all know that with big data and whatever, this can be quite easily put together. The big problem is this is a relatively new phenomenon. So if we start the sample 15 years ago or something, of course, there will be a discontinuity in the data. So that's certainly one major problem. The other point which you mentioned are the policy issues. And I do agree that they are very, very important. And of course, for people who will like to read our book, which I will actually possibly show, if you allow me, now in the slides. we actually, in that book, we certainly present many other aspects which could be useful. And the aspect I want to refer to is about the design of the Chinese stock market in the early 1990s when the market was started, because this is a quite interesting, I would say, experiment, because they were working within a socialist market economy. Why would you need a stock market in a socialist market economy? And the answer is, well, we don't, at that time, there was no answer. They had to really start from scratch. There were some people thinking about these in Central Eastern European countries in the 1980s, but very little in terms of the results. So they had to design a completely new system. And what was the motivation in setting up this system? It was to finance state-owned firms, because they were initially the only ones allowed to issue shares on the Chinese stock market. Of course, later on this changed and so on, but this was a major motivation to solve an ongoing problem, which was non-performing loans. The state-owned firms did not pay back their loans, and they basically, the government said, okay, just issue shares. You never have to pay back shares. So the non-performing loan story disappeared, or, well, not fully, but partly. I think these things are very important to keep in mind when we see these so-called anomalies. Well, okay, the problem is this is a quite specific economy where the stock market may not play the same role as in, say, advanced OECD countries that we all know about. Mm-hmm. And the last thing, if you allow me, is, of course, about these new waves of individual investors, which we have in, say, US stock market or some others. And really the lesson from the Chinese case is that the regulators should be very careful in stimulating this type of new participation, because people are really taking huge risks. They are on average losing money. So it's really, in some way, an issue of wealth redistribution. You are taking money from uninformed investors, moving it to informed investors. So it may not be really the thing that the regulators would like to stimulate. Thank you.
Thank you very much, Eric, and for that response. So for sharing the insight, about the book. I think we should be able to get access to this book and look at it. Very interesting title and content of details. Now, I see two hands up. I don't know whether these are legacy hands or new hands, but I see a hand of Bo and a hand of Hong. So, Bo, do you want to go first? It is a, yeah. Bo, is this another hand?
My hand is a new hand, actually.
Hey, okay, please go ahead.
Hi, yeah. Good to see you. So, yes, I agree. And Eric, I agree. Initially, it was designed to help state-owned enterprises. But my question is, what do you think about the future of the Chinese stock market? You also mentioned that individual investors are very risky. And so what? So why do we still have this? So what will be the function of the Chinese stock market in the whole financial system then?
Should I answer now?
Yes, please go ahead, Eric. Yeah.
Okay. Thank you very much for this very stimulative question. In terms of individual investors, they need this because they had nothing else. That's a problem. The portfolio choice of individual investors is incomplete. They would need to have access to safe assets like government bonds, even though, of course, SVB saw that there is some interest rate risk on these government bonds, but still, really, if they could have a full portfolio, and possibly this is a stock connect, the external financial opening, maybe at some stage individual investors will be allowed to buy foreign stocks, which currently they cannot really do. So that's in some ways the answer about the future. Diversification in the portfolio of Chinese individual investors, which would mean that some of that money would shift to other assets, domestic or foreign assets. I think that's certainly something which we should wish to happen, because these waves of enthusiasm are certainly excessive, and they are only explained because, well, there is no other game in town except housing. But housing, of course, is completely different type of market, especially in China, but also in general. The liquidity of the housing market and so on and so forth is certainly of a different nature. Now, your first question, the future of the market itself, again, it will all depend on the extent to which the authorities allow foreign financial institutions to intervene more inside the Chinese market. So really, this opening to foreign capital flows, is it going to be increased in the future? Should we wish that to happen or not? We know what are the risks involved. And here it's another lesson of the Chinese experience, that the government and the regulators have been very cautious in the external financial opening. And possibly they have not had huge financial crises. So maybe we should try to relate the two in terms of policy advice for the future.
Maybe. Thank you.
Thank you.
Let's guys. Yeah.
Okay. Thank you indeed. And I don't see any hands up anymore, and any further information in the chat. So all that remains for me is to thank Eric very fundamentally for the great work that you have shared with us, and also in many directions on the theory, the new evidence, insights into the market, much more fundamentally for all the work you've been doing over quite a long period of time. And also for, yes, endorsing that, yes, we could go forward in many directions on this great work. It's quite possible, as it happens in these seminars, that some questions will come up, and we will indeed reach out to you. And of course, there is a recording of this seminar that we, Sina and Meng, will share with you. But indeed, yeah, there will be some further interaction well beyond this particular session. And we hope that next year we'll have a one-to-one interaction, in-person meetings, and we'll invite you again to SOAS, and then we can usually do the kind of social interaction after the seminar. But for now, since we are on the Teams, we will stop here, and thank you fundamentally. I also want to take this opportunity to thank all the participants, for being able to make it, for the ideas, and we thank you, as always. Okay, so I think let me close the seminar And thank you indeed. I just show a hand of applause to you participants and to Eric as our guest speaker.